All right, number 13, commission agreements and bonus plans.
So, when you have an employee, right, you have to decide are they hourly or salary, and then, how they're paid. Just because you have an hourly employee, that's the minimum that you have to pay them. That means that for every hour work, you have to pay a minimum wage, and when they work overtime hours, you've got to pay them times and a half. It doesn't prohibit you from paying them commissions or bonuses or anything else, any other payment outside of the hourly rate. The takeaway here is that when hourly employees are receiving their pay, overtime is not times and a half their hourly pay, it's times and a half what they're paid, their total comp. And so if I pay you $10 an hour, but I also give you a $100 bonus during the same pay period, okay, and you work overtime, your overtime rate is not $15 an hour. Your overtime rate, you've got to factor in the $100.
Okay.
And so it's $16
so
maybe an hour.
Yeah, okay. So you would take whatever the average is.
There's a complicated formula.
1.5.
Yes, there's a complicated formula that there's a California specific one, there's a federal one, but the concept is that when you pay an hourly employee outside their hourly rate, like a bonus, you've got to take that bonus into account when figuring out their overtime.
What about profit sharing?
Profit sharing is a narrow exception, but it's got to be true profit sharing. And typically they just call it profit sharing and it's really a bonus. Okay. And so it doesn't matter. And there's an exclusion for discretionary bonuses, but the name itself doesn't control. Okay. If you incentivize the employee, if you typically give it out, it's non-discretionary. Things that can be kept outside of this calculation are expense reimbursements.
Okay.
And so if I'm going to say, here's 55 cents a mile or whatever it is for driving, that doesn't need to go into the calculation.
So what's the major difference between bonuses and profit sharing? Like the line, how you're on one side of that or the other?
Typically, you've got to have a very formal profit sharing plan that meets certain tax requirements. The standard to meet is different. If you're looking at California standard, I believe in the California Labor Commission actually sets forth the requirements.
It's a very specific question.
It is. And I would tell you that I have not had a restaurant client yet who's given their hourly employees any profit sharing.
I think the key here is if you do a profit sharing, have a lawyer look at it to make sure that it's exempt.
Absolutely.
Got you. Cool. Moving on to number 14. If at any point, if we want to abandon the buckets, just let me know.
No, I'll tell you. That's the reason. You're like, where's the next bucket?
Yeah.
The next bucket comes after. The last three buckets are their own little 18, 19, and 20 because so much of this is wage hour because that's where operators' risk is.
All right, cool. I don't know why I'm so hung up on the buckets.
Because you like five. Five's good.
Yeah, so we're at number 13. We just did commission agreement and bonus plans. Number 14, expense reimbursements. Get into it.
So the concept is that if you're an employer and you ask an employee to do something and they need to use a tool or do something, incur an expense in order to fulfill their job, then that's an expense that you have to reimburse. There's no federal law that requires that. It's state by state. Excuse me.
No, get it out.
Sorry. There are some federal laws about it, in the sense that if you are having employees incur expenses and it brings them below the minimum wage, that becomes a problem. But generally speaking, it's a state-by-state issue. California has a statute that says employees have to be reimbursed. But that's been extended multiple ways. So, for instance, if you're driving, well, how much do I reimburse someone? Do I just pay for their gas? Well, what about their insurance? And what about the wear and tear on the car? And so the IRS has come out with a mileage rate. And so it says, look, you can use this rate to reimburse. But there's many different things that an employee could be using besides their car, their cell phone. So if I have my own personal cell phone, or everyone's got their own cell phone these days. So they come in and they're a server. And as an employer, you're not issuing cell phones to servers. And you're not telling servers you need to have a phone. But if I'm communicating with my servers via their phone, if I'm texting with them, and if they don't respond to the text, I'm saying, why haven't you responded? And that's a requirement. I've required the server basically to have a cell phone because that's how I'm communicating with them. So then I've required that, and it's expensive, so now they have to reimburse for the cell phone.
Yeah.
And that doesn't mean you have to pay their whole cell phone bill, but there's court cases that say you have to look and see how much of the device is work-related, and you've got to reimburse that amount.
What about just communicating outside of work hours?
That can be off-the-clock issues.
Yeah, because, I mean, I think that's one thing today. Like, if you're texting somebody who's off the clock and they're having to and you're expecting them to reply to you right away. I mean, maybe that's outside of this realm.
No, it's not. It's combining the timekeeping and this in one. And the concept is that if you're going to either prohibit that as a company and actually follow that, Or if you know that's going to happen, set up safeguards so you're not, without a defense if you get sued on it. And so the safeguards can be, look, if you know your managers are going to call up, post a schedule, but have them call up also. And if that happens, have them fill out a time adjustment form. Also, if they call up, reimburse them, add $5 for reimbursement. So you can argue, look, for this week when we called you on your cell phone, like it was about $5 worth. And so here it is.
Yeah.
And people are very afraid about the reimbursements. I honestly think that if it's legitimate, it's actually a good thing because you can pay employees an expense reimbursement. It's an amount. It doesn't have to be factored into overtime. It doesn't get taxed as wages. Now, theoretically, it evens out the employee because they're incurring the expense. But if you got an employee and they're bent out of shape about stuff, and it's like, you know what, they're using their cell phone anyway, and it's happening. So why don't I just reimburse $10 a month from here on?
Are there any other examples that come to mind as where this expense reimbursement comes in? It's not so obvious.
And let's go to number 15 because I created that, and that's uniforms and tools.
Oh, I was just going to ask about uniforms and tools.
Okay,
but I was holding off.
No,
okay.
Perfect. So item number 15, I'll do the intro to this one. Is uniforms and tools. And the concept is that if certain states have regulations that say if you're requiring someone to wear something specific enough, that's a uniform. And if it's a uniform, you have to reimburse for it. So, for instance, California says you can ask a worker or employee to wear a white shirt and dark pants and dark non-slip shoes. That's generic enough that you don't have to reimburse for that. But if I tell you to wear a Hawaiian shirt, you got to wear a Hawaiian shirt. I don't say it has to be a logo shirt. Doesn't have to say the logo of the restaurant, just any Hawaiian shirt. But I'm requiring, that's now a uniform. I'm requiring I have to reimburse for that.
Okay.
And if I say it's got to be a pressed Hawaiian shirt, then I've got to arguably reimburse for the dry cleaning bill because I'm telling the employee they've got to incur the expense of pressing the shirt.
What if they're a bougie AF employee that goes out to like the top shelf, clothing store to get like the nicest Hawaiian shirt that exists?
No, because it's
a $150 Hawaiian shirt.
Well, if you as the employer had said come with a really nice Hawaiian shirt, then the employee's got an argument that that's what it is. But if not that, and it's just any Hawaiian shirt, as the employer, you'd argue you're only entitled to a reasonable reimbursement. We didn't require, and the concept comes up a lot in travel, first class travel. It's like, hey, we're sending you to the restaurant conference, whatever it is. The employee gets on a flight first class and gives you $1,000 reimbursement receipt. You reimburse for $500 because you say that's the price of the coach ticket. We're requiring you to get there, but we didn't tell you had to go first class.
Okay, so do you have to specify you're not allowed to spend more than this on a shirt or something like that?
That's reimbursement policies. Typically, they have that for that reason. So there's no discrepancy later about what you were asking the employee, what expense you were asking them to incur. If you don't have a cap on it, to your point, the employee can go out and buy a really expensive Hawaiian shirt and say, this is what I thought I needed.
Cool. Anything else in that vertical?
It's state by state. It's another state by state issue. So there's lots of states that don't have a reimbursement requirement, don't have a uniform requirement as strict as California or states like New York.
Okay, so I guess that's wrapped up, right?
Yes, that's wrapped up.
Okay, number 16 then. I guess that was 15. This
that's
number
right.
16. Tips versus service charges.
So we're going to do 16 is tips and 17 is service charges.
Gotcha.
So to kind of lay the groundwork there, tips are truly voluntary, right? A customer can decide to leave it or not. You can have a suggested amount, but it's not added in. It's not a mandatory amount versus a service charge, where you often see it at the bottom of a bill, parties of 6 or more, automatic 20% gratuity. That's an automatic charge. Or you'll see restaurants now that say 5% added for whatever, for operations or for healthcare costs or various things. The first step as an operator is you have to categorize these into 2 different buckets because the rules are completely different from a tax perspective, from a wage hour perspective, really from a reporting perspective, from every perspective. And so you have to look as an operator, where are these things happening, right? I have a lot of situations where I'll say, do you use service charge? No, we don't do that. And I say, okay, let me see your catering contracts. And in the catering contract or the private event or the buyout agreement, whatever you want to call it, it says right there 18% automatically added. I'm like, well, there you go. I'm like, what are you doing with that amount? Oh, we just give it to the servers. They just have it. We treat it like tips. I'm like, well, it's not tips. There's different rules. And so you have to look really as an operator and capture all of these and not what you call it. It's whether you're adding it or not. And so going back to 16 tips itself, right? It's highly regulated. It's different in each state. It was controversial very recently because a lot of employers have mandatory tip pooling policies, which basically says, look, whoever gets the tip, you've got to put it into a pool and we're going to share it with everybody or share it with certain people. It used to be that you couldn't share that with people in the back of the house.
Okay.
Now you can.
Okay, so what's the big difference between a tip and a service charge? Just like lay that out one more time.
The tip belongs to the employee.
Okay.
And so, the tip belongs to whom it's left.
Okay.
So if I'm eating, I leave $100 on the table. That is who the server that picks it up. That's their money. That's not the house's money. That's not the company's money. That doesn't get paid as wages. It doesn't get paid through payroll. There's no sales tax on that amount of money. That's almost a transaction entirely between the customer and the server.
Okay. So where it becomes a service charge is when the restaurant steps in and then takes the money.
Well, no. What happens is that it's always a tip, right? Because whether it's a tip or a service charge is determined solely by is it mandatory or not at that point in time. Is the restaurant saying this is a mandatory charge or is the customer leaving it? If the customer leaves it, again, it's like, who am I leaving it to? They leave it to the server, so that's their money. And then how it's governed, the restaurant can tell servers, or whoever gets the tip, pool those monies together and we're going to share it among you. What the restaurant cannot do is take it themselves.
Gotcha.
And there's different state laws in each state. A service charge, though, is just like money they took into the restaurant, right? If I had a service charge of 20% for parties of 6 or more, that's the same thing as me making my hamburger on the menu $10 and raising it to $12. That extra $2, that extra 20%, call it a service charge, call it upping the prices. It's the house's money.
Okay.
And so when it gets paid back out, it's got to be paid out like anything else paid out to employees, as wages. Mm-hmm. So a lot of employers run into trouble because they'll do something that's a service charge and they'll treat it like tips. Well, you really ran into problems there, right? You didn't tax it correctly.
Yep.
It didn't go through payroll. Also, you run into the problem I talked about earlier, which is you paid out a flat amount to employees as a bonus, basically, without putting it into overtime.
So now you got to consider this as overtime.
Correct. Yeah. And so it's very complicated when you're going to introduce service charges. You've basically got a whole other pay scheme.
Okay. So what would you say the best practice is when it comes to tips versus service charge? What would you recommend restaurant owners lean towards?
I would recommend a individualized approach. You look at your concept, you look at your customer base, and you decide, am I going to be all tips? Am I going to be all service charge? One or the other, which is easier. And even on the all service charge, you can refuse tip. You can say don't accept tips, but if the customer tips, it belongs to the worker.
So if you do tips, the tip model, you're kind of removing the responsibility from yourself. It becomes their responsibility at this point.
Unless you want to decide to pool the tips, right? So the decision tree is: are we going to do tips or service charges? If tips, are we going to have the servers or the tip receivers pool the tips? If service charges, are we going to pay it back to the employees, or are we going to keep it for the house? Either way, or is there a third path, which is the hybrid approach, which a lot of restaurants are doing without realizing? Oh, it's tip only, except in these narrow situations, 6 or more, private events, or we're doing service charges. And in that situations, have your payroll provider have the 2 parallel paths set up so you can pay out the service charges and the tips to the employee in the right way.
Would you say it's best practice to lean one direction or the other to simplify things?
Yeah, but look, revenue is king, and so the last thing I want to do is be a lawyer who comes in and tells the operator sacrifice revenue because you think this is easier from a compliance. I would say that before you make the decision, play it all out, because I've seen too many operators say I want to go service charge, and then when they realize how it's going to play out and the administrative headache behind it, they then backtrack. But that's a little late after they've already introed it.
Got you. Okay, I think we've sewed that one up pretty good.